Massachusetts. We have all right. Well, good evening. I'm Opal Elliott, a volunteer community ambassador with AARP Virginia. And I'll be joined tonight with my colleague and Virginia Community Ambassador, Trudy Murado, who will field your questions in the question and answer Q&A section. So welcome to AARP Virginia's Retirement Planning webinar, and thank you for joining us today. This program is scheduled to run 80 minutes, but we may finish a bit early depending on how many questions you submit. AARP really believes that preparing for our financial future is all about achieving the concrete financial milestones that make sense for us. Even if these milestones are very modest, each one makes our financial future bright and more secure. So we applaud you for deciding to spend time with us this Tuesday evening, thinking about and planning for your financial future. So retirement planning doesn't have to be daunting. In this evening's program, you'll learn some tips for determining if you're on track and learn practical strategies to help you achieve retirement peace of mind. In the reminder email for today's session, we included a link to download the slide presentation and a link to the resources page listing all the websites that we'll be sharing this evening. So I am thrilled, really thrilled to be joined this evening by Pamela Sams. Like me, Pamela is an AARP Virginia volunteer community ambassador, and we're very fortunate to have her on our team. Pamela is a chartered retirement planning counselor, and she spent the last 20 years helping people improve their personal and financial wealth through solid financial planning. Pamela is a strong advocate for financial literacy, and she voluntarily conducts financial education seminars and workshops on behalf of AARP. While Pamela is indeed a financial planning professional, her role here this evening is to provide general guidance, not specific or advice or recommendations, but hopefully the information we cover and the resources we share will help you make an informed decision about your financial future. So with that, please give a warm Zoom welcome to Pamela Sams.
Thank
It's
you.
all yours.
Thank you very much, Opal, for the kind words, and welcome to everyone and Happy New Year. I was talking to somebody earlier. I don't know when we stopped saying Happy New Year. It's mid-January, but this is our first webinar for 2022. So Happy New Year and welcome. As Opal mentioned, my name is Pamela Sams, and I am a volunteer community ambassador with AARP. I will be facilitating tonight's conversation about retirement planning with you. But before I do that, remember this presentation is intended to provide the general guidance, not specific legal and/or financial advice. Any individual circumstances may differ and really should be taken into consideration before acting on any of the strategies that I will mention in this presentation tonight. As Opal mentioned, even though I am a financial expert, I'm not going to provide any specific advice or recommendations, but hopefully the information we'll cover today will help you make those informed decisions about your own financial future. Be sure you consult a professional for advice regarding your own detailed personal situation. Now let's just take a look at the agenda for today's presentation before we move forward. Welcome again, AARP Retirement Planning presentation. I'll share information about the most important aspects of your financial health as you define your own financial goals, your set your priorities, and prepare for retirement and take those steps to secure your future. We'll provide information that will help you recognize the steps that you do need to take to prepare for retirement, no matter where you are in your financial life. Now, remember, personal finance is just that. It is personal and not a one-size-fits-all. As such, you really need to, like I said before, consult a professional to make any plans that are best for you. AARP does provide a number of resources that I will be sharing with you tonight for you to really refer to as you take your own financial journey. And we'll cover many of those in this presentation tonight. Now, in this session, what you'll learn is really ways to determine how much money you will need for retirement compared to how much that you already have and that you're on track to have saved for retirement. And then also strategies to bridge the gap if there is or you discover a gap in your plan. Now, everybody's probably been on Zoom, but just a quick housekeeping details. This is a picture of what you should be seeing at the bottom of your Zoom screen or PC. You may be on a laptop or an iPhone, but possibly this may be on the top of any of the screens that you have. Everybody is currently on mute. If you want to submit a question or comment, please click on the button, the chat or Q&A to type in your questions, but I believe we'll probably just be using the chat for that. If you are watching on Facebook Live, you can type in your questions in the comment field as well, and we'll field those questions toward the end of the presentation. We will not be using the raise hand command because questions will be submitted, as I mentioned before, in the Q&A, and we recommend that you select the speaker view rather than gallery so you can view the entire presentation. You can do this by clicking on the upper right part of your screen, and once you are there, you can change the view from speaker to, from gallery to speaker. Now, this is a judgment-free zone, so no questions are poor questions, and nobody's going to judge your questions. So this is a judgment-free zone. Now, be cautious. As I mentioned before, personal finance is just that, it's personal. So share only limited personal financial information in this group setting. So I want you to be cognizant of that. Now, before we get started on today, I really want to go over a couple of poll questions and just kind of see where we are in the process. So how many years do you plan to stay in the workforce? So if you could take a few minutes and fill out this poll, and then we'll have another poll after that.
Hang on, Pamela, I messed up something here.
Okay.
I have to relaunch it. There we are.
Okay. So how many years do you plan to stay in the workforce? Okay, we got a pretty good amount in. Okay, so we have a fair amount of people that are less than 5 years. So this is really a good presentation for people that are within that 5 to 10 and less than 5 years for retirement. And then we have a fair amount that's already retired. So we appreciate you stopping in just to get a little bit more information or tips on retirement planning as well. The next poll we have is which best describes your current situation? And then we'll take a few minutes to fill that one out. Okay, we're coming in pretty good. All right, so a fair amount that are in the private industry. We have some federal employees, about 6% there, and then fully retired and do not plan to work again. Just enjoying the good life, I believe. So it looks like basically probably half of you guys are in private industry. So what I will be talking about today will probably pertain to, of course, most people who are planning for retirement. But since we do have some federal employees on this call or webinar, then I'll address some of the things that are specific for federal employees. But thank you very much for sharing. So moving on, some more time for you to do some sharing. So let's do a quick warm up just to get you thinking about today's topic. And the first step is really to visualize the kind of retirement that you want. Do you want to focus on a hobby, maybe traveling, a volunteer work like we do here at AARP Virginia? spend time with your kids or their grandkids, or maybe even start a second, what I call a second act, or start a business. So if we can take a few minutes just to write down a few words that come to mind when you think about your retirement goals. And if you can just put that in the chat, and we'll have a little bit of a discussion about what some words that come out of that conversation. So a minute, pause for a minute or so, just to share a few ideas of what you visualize for retirement for yourself. And I believe Trudy's going to be looking at those for me. Anything come through?
I am. It just takes me a minute
Okay.
to unmute and put my things back on. We are going to travel, spend time with family, travel less, maybe work part-time, hobbies, taking care of elderly parents. Oh, someone is after my own heart. They're going to sleep. I would.
We all definitely need to catch up on more sleep. Yes.
Oh, I like this one too. Live on my boat.
Oh, that is awesome. Those are some really good ideas. I'm liking the sleeping and I'm liking the boat.
Exactly.
So thank you very much for sharing, guys, and thank you very much, Rudy, for sharing that with me as well. But those are, like I said, some excellent ideas. And this can be a valuable exercise as you go through, not just tonight, but when you start to plan for your retirement. So after the session today, I really encourage you to do some reflecting. The retirement planning, of course, is about the money. That's a big aspect of it, but it's also about what you're going to do in retirement. So consider writing down your choices and then ranking them in the order of importance, and be specific as possible. This can really help to determine how much, what matters the most to you. Also, whether you will need the same, less, or even possibly more money to support your lifestyle in retirement. So thank you for participating. And now let's look at the first topic, determining what you're going to need in retirement. So how much money are you actually going to need? That's one of the questions that I get a lot as a financial advisor, is how much money am I going to need? It's a question that we ask ourselves, and that's where we are here to help you tonight. What we're going to do is walk through the steps in calculating how much money you will need for retirement in this section. We'll meet a hypothetical couple that are doing the same work, just like you guys may be doing. So we're going to refer to them in the example as we begin, as you begin to make your own calculations as well. And at the end of the portion of this presentation, we'll be able to identify some of the resources that needed to allow to calculate your own projected retirement needs. And we will have some useful and free tools that are available on the AARP.org/money for this section, which is the AARP retirement calculator. The link should have been in the handouts that you received on your email, but also we'll put a lot of the information as well in the chat, so you'll have that for your records after this session. So after today's session, I really encourage you to take the time to go to the tool on AARP.org/money to do your own calculations to see where you are in the retirement planning process. Now, as I mentioned before, this presentation is going to follow a hypothetical couple. So we're going to meet here, Pat, at age 55, and Ronnie, age 52. They've been legally married for the last 20 years, and as they calculate their retirement needs, Pat works full-time and earns a salary of $60,000 per year, and Ronnie works also full-time, earning a salary of $50,000 per year. They both plan to retire at age 67, and they're saving about 8%, that's about $8,000 of their income per year for retirement right now. They've decided to sit down together and really figure out how much money they're going to need in order to retire. And the first calculation that they need to make is their current retirement savings. That is basically how much money they currently have in their retirement funds. And so what we're going to do now is take a look at how we're going to find those numbers before we move on the calculations. So a common source of retirement income for most Americans will be a retirement plan through their employer. Some of you may already have some of these accounts, while others, of course, may not. So don't worry if you don't have any of these. This is just an example of some of the retirement income that most Americans have. Now, the most common ones for employee of the retirement income plans are employer-sponsored retirement plans. These days would be a 401k, a 403b if you're more into teachers or government workers, etc. We had a few federal employees on the line, so that would be your TSP, would fall into this category. Now, these are often referred to as defined contribution plans, which means these are the types of retirement savings plans that employees contribute a fixed amount of their income to fund their own retirement. Now, in a defined contribution plan, the onus is on employees to make that decision and to take action. Now, they decide whether to enroll in the plan unless they are automatically enrolled. A lot of the plans these days are doing auto enroll, which means, if you would have to opt out of the plan in order to not be involved. This is a common practice that most employers are using, as I mentioned before, particularly among larger employers. So employees decide whether to enroll, how much they're going to contribute to the plan from their paycheck, and then how to invest those assets. Now, a tip here is really to have these types of accounts is your current portfolio. Ensure that you're getting the maximum matching funds from your employer if they are available or if they're matching. Now, the less common type of employer-sponsored plans would be the traditional pensions. As I mentioned before, we have a few federal employees on here. You guys have a pension. One would be the FERS, Federal Employment Retirement, and or CSRS, which is Silver Service. So that's basically prior to 1983, I believe. So those would be traditional retirement plan pensions that you would have. And then the funds in those plans, once you have met certain requirements. So usually using the number of years that you worked, typically 5 years or more when you retire. And then you receive a specific defined, that's why they call it defined benefit plan, every month for your retirement for as long as you live. So those are your pension plans. We will discuss non-employer sponsored plans such as Roth IRAs, traditional IRAs a little bit more in depth in a later part of this presentation. But if you do currently have them, you should also include these among the amounts that you have with your other types of plans that we reviewed in your calculations of the amount of money that you currently have. Next up, we're going to take a look at your Social Security benefits because that feeds into your ultimate retirement income as well. So for many of us, Social Security is the most important part of our retirement picture. Deciding when to claim is a big decision. The amount of Social Security you collect over your lifespan will depend on your lifetime earnings, your highest income generally over the last 35 years. You probably heard of 40 quarters, but they only take the concentrated 35 years. They kind of knock off those 5 years where you worked at the ice cream shop when you're 16 and things like that. So they're just concentrating on those 35 years. And the age you start collecting, and then the number of years that you collect your benefit. So when you claim is a very personal and very important decision. Now, if you're married and you both earn a benefit, Social Security will compare your own benefit to the benefit that you collect on your spouse's record and then pay you the higher of the two. So if you're married and you have kind of a lopsided income situation, Social Security will look at that and give you the higher of the two amount if that's going to be either half of your spouse's pension, which may be higher than your own record. So Social Security will determine that for you. If you do qualify for Social Security by paying Social Security tax on your earnings while you work, that's that 40 quarters I talked about before. So you or your spouse need to have worked and paid into Social Security tax for at least that 10 years to be eligible to receive Social Security benefits. There are also survivor benefits, there's spousal benefits, there's disability benefits, there's a whole lot of different ones, and they have their own criteria in terms of qualifications. You want to refer to Social Security Administration, which is ssa.gov, but we also have resources on the AARP Social Security Resource Center as well for more information. The link again in your handout or in your email, and we'll also put that information in the chat for you so you'll have that. Next up, we're going to explore why it pays to wait for Social Security. That's one of those things all the time is when should I collect Social Security? 62 is the earliest. Then you have your full retirement age, and then you have delayed credits at 70. So this is what this is going to show you right now. Now, let's take a time to review the information to help you make a decision in regards to your own Social Security benefits. When it comes to claiming Social Security, you have choices that's going to impact that overall benefit. One option considering is waiting, as I mentioned before, in order to increase your monthly benefit amount. You will also receive your full benefit at your normal or full retirement age. You may see something on your statement that says FRA, that basically acronym for full retirement age, which is somewhere for most of us would be somewhere between 66 and 67. You probably see 66 in 2 months, 66 in 4 months, but somewhere in between 66 and 67, depending on the year that you were born. Now, you could also receive certain benefits as early as 62. That's the first time you become eligible to receive Social Security benefits. But however, there is a caveat. If you do decide to take it early at 62 when you're first eligible, it's going to be reduced by about 25 to 30%, depending on your full retirement age for the rest of your life. So that's going to be a permanent reduction in your Social Security benefits if you decide to take it early at 62. And as long as your survivor claims them as well. So that's why it's a very important decision to consider the impact it's going to have on your family and not just your own benefit if you do decide to take it early. Now, you could also do what we call the delay your benefits beyond your full retirement age. So beyond 67, which would the next stopping point would be 70. So this increases your benefit amount by 8% per year up until age 70. So let's say, for example, you retire at 67. For each year you don't take Social Security benefits past that 67, it grows by 8% up until age 70. So that does, pay to wait for that. Now, the chart on this slide shows you claiming ages and the impact of it. So if Pat's full benefit is $21.57 per month, at his full retirement age 67, this is shown on that pink bar labeled 67, and any benefits received earlier will be shown in the pink and the red. That's 62 to 67 in the red. You can see the reduction in any of the benefits that he has prior to that. So after age 67, we kind of see where things start to increase in that purple, which would be the maximum benefit amount. That would be the higher number. Now, if you haven't yet done or created your own personal My Social Security account, you can go, as I mentioned before, to the Social Security Administration website. It's ssa.gov/my account, and you can view your personalized version of your benefits outlook. They used to send those nice, pretty green and white statements in the mail closer to your birthday. They're saving money on postage, so they're suggesting most people go to the website so they can set up their own account, username, password, and then you can access your benefits outlook. So from the My SSA, you can calculate what your expected payout's going to be and your benefits, and then you can also monitor any Social Security news and updates, such as increases in benefits amounts. Because I believe this year a lot of people got a Social Security increase, so you can receive news like that. Of course, again, the link is going to be in the chat, and you have it as part of your email as well. Now, as I mentioned before, deciding when to claim is a very personal decision that only you can make. Now, remember though, the impact that the claiming age does have on your, not only your retirement benefits, but also your survivor benefits for your spouse, which may outlive you. So you want to make sure you're not going to take any reductions, because it's going to ultimately impact both you and also survivor benefits. So keep that in mind as well. Next up, let's take a look at what Pat and Ronnie will receive in their Social Security benefits. So as I mentioned before, Pat and Ronnie will retire at age 67. And then they're considering to do in the Social Security Administration, that's their full retirement age based on the year in which they were born. They're going to take their Social Security payouts beginning at 67. As I mentioned before in the previous slide, 2157 was Pat's, and then 1890 was Ronnie's per month. Now, however, if they also done the calculations to see how much money they could have if they waited, to claim their benefits. So they found if they waited that 3 years from 67 to 70, as I mentioned before, the Social Security payouts for Pat would be 2675 versus the 2157. And then for Ronnie, for 1890, that was the 67. If she delayed it until 70, that would be 2344. So you can see that's about a 24% increase just by waiting those additional 3 years to claim Social Security. To figure out the number for yourself, again, I mentioned the AARP Social Security calculator. You can find it on AARP.org/Social Security benefits in order to look at the calculator. But as I mentioned before, it does pay to wait to age 70. If you can wait to say age 70, sometimes, you get to full retirement age and those are the only resources that you have, then you may have to do that. But if you can, 70 may be the number for you. Next up, let's consider your lifestyle and then really how it affects your overall retirement savings. Now, how much are you going to spend in retirement? Will you spend more? Will you stay about the same? Start living a little modestly to stretch those dollars a little bit further? So that's really just going to depend on each person's lifestyle. The AARP retirement calculator makes educated guess based on your current lifestyle by starting with your current income, deducting any employment and income taxes, and subtracting the amount that you're saving. And then what's left is your current lifestyle figure. The calculator is going to assume that in retirement, you will spend about 85% in the figure to live close to about the same lifestyle that you are now, because expenses typically, I'm gonna say typically, tend to be a little bit lower for retirees. Now, this amount becomes your retirement spending goal, which with adjustment for inflation each year. Inflation generally runs somewhere about 2 to 3.5%. So the calculator is going to take that into consideration when you put in your numbers. You can adjust this amount of lifestyle in the area of the calculator just by selecting the retirement lifestyle that is either lower, higher, or about the same as the expenses that you have now. The more moderate lifestyle, you want to assume about 75% of your current income. More extravagant lifestyle, you have about 95%. And then the calculator allows you to kind of do more of a sliding specific percentage to apply to your current lifestyle just to see how much you're going to need. So to determine how much you'll spend in retirement, we'll make sure that you have accounted for all of the potential expenses, be conservative in your estimates, and it's better to have too much rather than not enough. So you want to make sure you plan accordingly with your lifestyle. There are about 3 phases of retirement you really need to think about. Kind of first phase would be what they call the no-go year, or sorry, the go-go years. So the first part of your retirement, you may end up spending a little bit more money because you want to get all of that, out of your system. So you're going to be traveling, you're going to be doing hobbies, you're going to be doing a lot. Then you'll have slow-go years, which is somewhere in the middle. So your expenses may go down a little bit, and then you have the no-go years on the back end of your retirement, which may be a little bit higher because you have increased healthcare costs, long-term care, and a lot of those. So consider that when you're planning for your retirement as well. Now that Pat and Ronnie have compiled all their numbers, they can easily review where they stand when it comes to meeting their retirement goals. As you can see on this chart, there's going to be a little bit of a gap there. Currently, Pat has about 100,000 in the 401k, and then Ronnie has about 75,000 in a 403b. Neither of them are going to receive a pension, and at full retirement age at 67 is when they plan to retire. Social Security is going to be $21.57 a month for Pat, and then of course Ronnie was the $18.90 per month for her. That plan is similar life. They're going to plan to live a similar lifestyle, so they're not going to increase the lifestyle. So somewhere about the same. So they've decided that based on their estimates is about 75% of their current income. Now they're going to use, or they have used, the AARP retirement calculator. You can see how their retirement savings spans over the years in this particular chart. The dark green is their net income after savings and taxes, and then the light green is their Social Security benefits. The gray in there is the funds that they're going to withdraw from for retirement savings, and then that red, as I mentioned before, represents the shortfall each year of their retirement, if the retirement that they have. In case Pat and Ronnie's, in this case, that shortfall begins at age 82, which is about the same time Pat and Ronnie retirement savings are going to projected to start running out. So in this chart, Pat and Ronnie are going to experience a shortfall of about $38,177.21. If they do nothing, if they don't make any changes at all in their retirement savings before they retire. So what can they do in order to bridge the gap? What we're going to do now is explore some of those strategies that can help them bridge the gap. If you do see a gap, or a need in the gap, don't feel, very overwhelmed or don't feel discouraged. However, you're not alone. A lot of people do have retirement gaps, and it's never too late to really start saving or change your course or change course corrections. There are many strategies that can be used to bridge the gap between where you are now and then where you hope to be. So in the next section, we'll discuss several steps that you want to consider if you determine that there is a retirement gap. But before we look at those strategies, I've been talking at you for the last 20, 25 minutes. Let's just stop for a minute and consider a time when you achieved the goal that you had set for yourself. And it may not have, it could have been a big purchase, a completion of a project. What type or planning was required for each of those goals? Now we're in January. I'm sure a lot of people are doing goal planning, so this may be a good exercise for you. What made you successful in achieving the goal? So we're just going to take a little time out again and take a few minutes just to jot down a particular time where you wanted to achieve a goal that you set for yourself, what type of planning that you had involved, and then how successful were you in achieving that goal. So let's just take a few minutes to do that. And then my colleague Trudy is going to let me know what is going on in the chat.
I don't have anything in the chat yet. Whoops.
Okay.
I was going to add something, but one of our guests beat me to it.
Okay.
And that is, I wrote it down and I reviewed it daily, and that is exactly what I did.
Got it. Yep. That's exactly what you need to do is, write it down and follow it. Any other suggestions or any other people with any insight or thoughts there?
That is all I have. And as I said, that was the first thing that I came up with. Oh, one more. I had a accountability partner. I haven't seen that phrase before, but that's a good partner to have.
Yes, that's the type of person that, you share goals together and you say, well, hold me accountable for this and I'll hold you accountable for that. And it all works out because that way, once you verbalize it to someone, you want to make it happen. It's just like, human nature. We don't want to disappoint the other person on that. So those are some really good ideas in order to achieve the goals. Thanks for participating in that. Now, would anybody, we went through that already. I'm sorry. Remember, these behaviors and our qualities can be transferred to this whole process of saving your money and your money goals as well, and any debt reduction strategies that we'll be talking about. So what we'll do is look at some of the ways to bridge the gap. A great place to start any goal for bridging a retirement savings gap is really to strengthen your current foundation. No matter what your age or your situation, you have unexplained expenses and debts that are difficult to manage and may jeopardize carefully made retirement plans. And in this section, what we'll do is introduce the dreaded B word, which is budget, plan for emergencies, and then reduce debt as well. These steps can help you stay on track to meet your retirement goals, regardless of the surprises that life may throw at you. So let's take a look a little bit about creating a budget. And it'll be interesting to kind of take it. I'm not going to stop it on a poll, but if people want to put down there if they have a budget or not, and then maybe we can address that towards the end with our questions. But everyone here probably knows what a budget is and might even have created one on their own. But we'd like to emphasize the importance of budgeting as it relates to your retirement planning. Your ability to save more for retirement is dependent on your ability to manage the money well, right, that you currently have now. Budgeting to create that margin, the difference between your monthly income and your expenses, and then also lowering your debt and saving is that first great first step that you want to do. There may be sneaky ways that money is disappearing each month. Just to name a few, there's late fees that you have. Back in the day when I mentioned late fees, it brought up the time where we used to rent movies and then you would take them back and then you didn't rewind it or something and then you would be charged late fees. I had that discussion with some kids, with my children not too long ago, and they're like, what? But anyway, I digress. There could be other banking fees, subscriptions that you didn't cancel, extra things on your phone or cable accounts, those extra little nitpicky things that you no longer need could be in your budget and you're not aware of it. I do this exercise towards the end and the beginning of each year, where I just kind of look at kind of the recap of what happened the year before, the nonsense that's in my budget, or my expenses that I didn't cancel. So I'm notorious for picking up subscriptions, streaming services, magazines. I love music, so I have tons of music streaming services and the stuff that I'm not even using. So I went and I canceled a lot of that, and I was able to free up another $100 of, just free up $100 just from nonsense stuff that was in my budget. So you want to go through these exercises to see if there's some things, late fees, banking fees, subscriptions, where you could free up a little bit of cash flow for that. By carefully monitoring income and expenses, like I said, you can free up hundreds of dollars each month just by going through a simple exercise like that. Your budget will help you plan your spending and savings in advance. So you want to take a look at that. AARP does offer a free online tool to help you set up your budget using the AARP Home Budget Calculator. It's a great calculator. The link, again, would be in your email, and we're going to put that in the chat. Remember, a budget is an awareness tool first, and a guide to really saving and planning for retirement a little bit later on. You may prefer a different method or system for budgeting. There's a lot of tools, there's a lot of apps out there, but nothing wrong with the good old-fashioned spreadsheet or even paper or pencil record as well. My mom for years used a ledger, the little green notebook and ledger and do that. So, if it works, whatever works for you, use what method works for you, electronic or old school spreadsheet or pen and paper. Now, let's think of your financial emergency preparedness. Just 39%, that's 39% of Americans would be able to cover $1,000 emergency if something unexpected happened. That is a huge number of people. And here's the issue that you want to consider. When we aren't prepared, we're more likely to pull out that plastic to cover those emergency expenses, which are likely not going to help you with your overall goals where you're trying to achieve, especially for retirement. For most people, the best place for the emergency fund would be a no fee or low fee bank account with no withdrawal penalties. It's possible you want to consider setting up an automatic savings option as well. So if it comes straight off your paycheck or straight out of your checking account to a savings account, just having a separate account with that reoccurring automatic transfer from your paycheck or that direct deposit, as I mentioned, really makes it a little bit more seamless for you. Consider putting a certain percentage into that savings account fund. Financial planners like myself typically recommend about 3 to 6 months worth of living expenses in an emergency fund. For most people, that could be an intimidating amount. Your best bet is really just simply to start an emergency fund with whatever you have and add to it regularly over time. It's the old adage, how do you eat an elephant? Basically one bite at a time. You start a little bit small in those bite-sized pieces, and then you work your way up to that larger amount. Now, if you are concerned about debt, again, you're not alone. A lot of people share debt or have the debt as an issue. The share of households led by older Americans that have debt has risen over the last 2 decades as well. So what's the best way to get those account balances down to zero once and for all? Number one, you want to plug the leaks. You can't lower debt if you keep adding to it. One tactic is really to use your credit cards or just simply taking it out of your wallet or your purse. Also, removing the one-click payments or stored credit card information on those online sites that helps you avoid the temptation. If you go to these online sites and you can just do a one and done, that builds up the temptation. So if you can remove those, that can help eliminate the need to go in and accumulate debt in that instance. Next, you want to stick to the budget that you just created that we had in the previous slide. 2 of the most popular debt restructuring strategies that you want to consider is the debt snowball and the debt avalanche. The snowball method really focuses on eliminating your smallest debts first, while the avalanche goes the other way, and it takes into consideration the highest priority of eliminating the debts with the highest interest rates. Simply put, the snowball method is really going to pay off the debts of the smallest amounts first, give you a little bit of motivation. You know, if you have a smaller amount and you can get that balance down to zero, versus the avalanche method takes a little bit more time in order to accumulate the pay down. So you're not maybe incentivized as much because you can't see the needle move. But either one, whichever you choose, just be sure to stick to one of those debt reduction strategies in order to get yourself or climb yourself out of debt there. There are additional strategies that you can customize to your specific situation. You want to check out the AARP Money Map, the link again in your information, and we're going to put that in the chat as well. So it's the AARP Money Map to look at some of the other debt reduction strategies that I didn't cover in this presentation. Now let's move on to discussing strategies for increasing retirement savings. That's pretty much why everybody showed up. How do I increase my retirement savings? We've discussed the importance of budgeting and debt reduction, as I mentioned before. Now I want to share with you some resources for long-term savings. First, we're going to explore your workplace options. Be sure you're getting the maximum matching funds at any of your employer-sponsored plans if available. Your employer may offer a match as long as you contribute the minimum percentage. So you want to make sure that you contribute at least the minimum in order to get the match. Through your employer plans, you can also often set the retirement contribution automatically, kind of an auto escalation of that to increase each percentage per year. This will allow you to increase the retirement contributions as your salary increase. So if you don't see it, you don't miss it. If your salary increase, more goes into your plan. As I mentioned before, this is called auto escalation. It is available in your plan. Just make sure you check with your employer or HR employer plan sponsor administrator to see if that's available in your plan, but it's called auto escalation. You also want to make sure you review your portfolio mix. There are several options as you relates to your portfolio. There's target date funds that adjust basically the portfolio mix less aggressively to a more conservative strategy as you get closer to your retirement age. There are also moderate, aggressive, conservative portfolios based on your risk tolerance for your retirement plans if you have them in your plan as well. You want to consult your employer's plan administrator to learn more about your investment options and your retirement plans through work. And if you are in need of direct advice, you may want to consult a financial advisor or your financial advisor professional in order to get some help in that area. There is a tool the AARP has. AARP has tons of tools. So this one is the AARP Interview and Advisor tool. This is a free resource to help you understand the financial advisor credentials, how they're compensated, any tips on how to start the conversation around what your needs are. And then the tool is also available on your smartphone, your tablet, computer, and the link is also provided to you in this presentation in the chat. Now, finally, if you are over age 50, you may also take advantage of a catch-up contribution. This is additional money that you can deposit into your account for an extra, $6,500 in your 401k, your 403b, your TSP for government workers. So over 50, you also have the catch-up provision. Next, let's explore your employer sponsored plans. I think I went too far. What happens when you get a little excited when you do these presentations? Did I do that one? I did that one already. Sorry about that. Increasing. We did that one. Here we go. All right. So there are additional retirement accounts that you can explore in addition or instead of your employer-sponsored options. So be sure to speak to a financial professional if you want to do anything outside of work, because they may or may not pertain to your particular situation. So first up, let's explore the Roth IRA. A Roth IRA is an after-tax individual retirement account, but they do have income limits that phase out your eligibility. You do want to check with the IRS, IRS.gov website just to see where those numbers are in terms of where it phases out. There's married filing, there's single, there's married filing jointly, married filing separately. Each of them have different rules on the eligibility for Roth, so you want to check that out. A great feature of the Roth is that you pay no tax on the gains as you take the qualified withdrawals. So you're not going to get any immediate tax benefits in the beginning, but on the back end, you don't have any tax when you withdraw. So you can withdraw contributions without penalty and or tax as the money comes out from the contributions, not the earnings amounts. And there's also no required minimum distributions for a Roth at age 72, contrary to the IRA or traditional IRA, where the required minimum distribution is at age 72. The traditional, on the other hand, IRA, you get a tax deferral or money that you contribute in today's tax environment, meaning it isn't taxed when you deposit it, so it's gross tax deferred, but you are going to pay tax on the contributions and the gains that you take out when you take out withdrawals. And again, they have the required minimum distribution at age 70 to take out money from any traditional IRAs. Generally speaking as well, you're going to have tax penalties if you withdraw money before 59 and a half. That's called that 59 and a half rule. Again, it's for retirement, so they don't want you to have to touch it prior to age 60. So the traditionals also have that 59 and a half rule, and then the Roths don't have that. The Roths do have a 5-year rule, though. You have to have it in the account for at least 5 years. So that's the only caveat there with the Roth. Now, these plans also have catch-up contributions, usually $1,000 in a Roth and traditional if you're over age 50. So again, the catch-up contribution that's needed there. With either option, much like the employer-sponsored plan, you want to review your portfolio mix and consult a professional as needed to make sure it's allocated properly and growing properly for you. Now, when you prepare yourself for retirement and employing any of these strategies to build the gap isn't enough, you want to consider other ways to cut back. Now, the strategies I will focus on now will really be looking at making lifestyle changes in order to meet some of those requirement needs. So what you're looking at here is really exploring some additional ways to bridge retirement fund gaps. The question is, of retirement, of course, is an important one, but generally speaking, the longer you can work, the more money that you will have coming in after retirement. So working longer is one of those options, which means there's going to be fewer retirement years that you need to finance. Also, there'll be more years of increased retirement savings. And if you have access to a pension, you'll have more years or, that you can reach those pension numbers, high 3s for federal employees, that consider that. And of course, this can also lead to higher Social Security benefits as well. Remember, again, we talked about kind of getting to that age 70. Remember that it does pay to wait. Now, working longer may also increase, like I said, the pension benefits if you do have one. Now, if possible, the longer you wait, working longer You can either do full-time, or you can do part-time, or you can do gig work. A lot of people are doing that these days. Could be a potential strategy to leverage additional resources for retirement. There's also AARP, like I said, they have tons of resources. AARP.org/work is a great useful tool to look at resources on the topic of additional work and how to continue to work if you need additional resources. So again, we're going to put that in the chat for you, so you'll have access to that. Another way to deal with the gap is really in the retirement funds is to consider downsizing. A lot of times people move from their larger home into a smaller home in order to save, if it's not going to, once the kids are out of the house and all of the expenses, you may want to, downsize and move somewhere else. First, you have to kind of consider some things. When you're moving, you may want to weigh the comparisons of if you own your home, you want to stay put, because the current house, you're going to have major repairs, especially if it's an older home, and then that's going to take money. On contrast, on the other hand, if you move, there could be some fix-up costs or on a whole house, and also moving expenses. And then the move may also take you from a house to an apartment. You have to consider rent payments going up gradually over time as well. Had you kept the old house, bought a new one, there's going to be taxes, there's going to be insurance, upkeep that could cost you and rise in cost as well over time. So when you downsize, you want to consider some of these things as you think about it. Thinking about liquidating some things, selling online is a great way to get started. However, remember to be realistic on selling price. These are used goods, whichever app that you choose to use. Be sure you protect your personal information. You want to communicate only in the app, and you don't want to give out any personal information, email address, phone numbers, addresses. If you choose to meet a buyer, do so in a public place, coffee shop, police station, or other public places. I don't think anybody's really meeting anybody these days during COVID. But downsizing, which would be moving. So consider the advantages and disadvantages there, and then selling some of your old goods that you can get resources from as well. The AARP ASTRA Retirement is also a good resource that you may want to look at. These are additional strategies you can use for bridging the gap as well. But downsizing and selling or liquidating are two of the good ones for you. Now, let's get back to our hypothetical couple, Pat and Ronnie. Let's see what happened with them. So we want to review the projected income. If they did not do anything, remember they had that $38,177.21 shortfall. They used the retirement calculator through AARP, and we saw that they had that shortfall. So what did they decide to do? First, they took some of the suggestions from this presentation. They created a budget that allowed them to see the difference between their monthly income and their expenses, which is called the margin. And their margin allowed them to build that emergency fund account, which prevented them from accumulating additional debt by using or tapping into their credit cards or into their retirement savings to manage any unplanned expenses. Next, they decided to tackle their credit card debt, and they used the avalanche method, which is the highest interest rate first, and then that's how they decided to do it. So they went from highest to lowest, and then they started paying off the highest credit cards first. Pat and Ronnie found it best to build their emergency fund first, and then they allocated that margin to pay off the credit cards from that. So freeing up some of that cash flow, they were able to reduce the credit card debt. Finally, a major decision they decided to do is decided to work longer. 67 wasn't going to be the number for them because they did have that shortfall. So they decided as a couple, hey, maybe we need to work a little bit longer. So they decided to retire at age 70 versus 67. Just those 3 years of working allowed them to have now, instead of that shortfall of $38,177.21, now they have a surplus of $163,840.32. That's almost a difference, and that is a difference of $125,663. So just by working those 3 years, they were able to increase their retirement savings again. They were able to get the higher Social Security benefit amount, and they were able to let their assets grow a little bit more for those 3 years and then end up in a surplus versus a deficit. Of course, these strategies are not going to work for every situation. These are some ideas that we shared with you tonight, but Pat and Ronnie are very pleased, and their planning paid off, and they're very optimistic about their overall retirement plan. Now, after, finally, after thoughtfully planning for your retirement and building your nest egg, you also want to take steps to protect your assets. One of the important aspects of this is really to protect yourself from any frauds or scams. There are a lot of them out, especially for older Americans who have built up a certain amount of wealth and they just become targets. So you want to make sure you protect yourself against fraud and scam. AARP, again, has wealth of resources to empower you. There's the Fraud Watch Network to learn more. Again, we're going to put that information for you in the chat. You can even sign up for the Watchdog Alerts. This is going to notify you of any latest scams or fraud tactics that are out there. The scammers are busy. So you want to get a hold of the Watchdog Alert so you can get the latest scams that are out there. If you have any loved ones that you suspect are a scam, have been victims of a scam, there's also a free helpline, and the number is listed right there, the 877-908-3360 number, that you can report that. The Fraud Watch Network is a free resource for all. With the AARP as your partner, you will also learn to proactively spot any scams. The grandparent scam is a big one that's out there now. Tax season is coming up, so the IRS scam is really big, where they need the information because you owe the IRS, and they're going to seize property and all of that. So beware of a lot of these scams that are out there. You want to get guidance from a fraud specialist if you have been targeted and you feel more secure knowing that you do have an advocate, either federal, state, and or local levels, to protect consumers and enforce the law on anything that happens in a fraud and scam situation. What I want to do now before we conclude is go ahead and open up the line for questions, and then we'll go over kind of a recap of what we talked about today. So, Trudy, are you filling questions?
Yes, I am.
Awesome.
I'm getting questions in both the chat box and the question and answer box.
Okay.
So,
I think I gave that direction in the beginning.
That's okay. I will be able to get to both sets of questions, but starting now, it would make it a lot easier on me to assist Pam if any questions you have would be put in the Q&A box. But I will try to get to the ones as quickly as I can and bounce back and forth.
Yeah.
The first one is really a comment, but I think it's a good comment, so I wanted to share it with you, Pamela, and with the group. And that comment was that this is a great program. They appreciate the basics of it, and that sometimes that's exactly what we need to do, is to just go back to basics.
Yeah, it is. Great. Thank you very much for that.
Exactly. Does the lifestyle calculator assume that you will or will not have a mortgage or a rent payment?
No, what the calculator is going to do is you're going to put in your expenses. So if you still have a mortgage and or rent payments, that's going to be included in your expenses. So they're not going to extract, the calculator is not going to extract out whatever you don't put into that. So if you're building in those rent payments and mortgages into the expenses, then that's what the calculator is going to do. And then basically reduce it by either the 75%, 95%, or whatever sliding adjustment or percentage that you put in.
Okay. Has the RMD, if I remember correctly, RMD is required minimum distribution? Oh, yep. Pam, I'm learning.
You are learning.
Okay. Has the required minimum distribution age changed? The inquiry was specifically, has it changed from 70 and a half to 72?
Yes, it has. With the Secure Act a few years back, they adjusted it to age 72 versus 70 and a half. But if you started taking RMDs when it was 70 and a half, then you're kind of grandfathered and you're stuck in that system. If you have not started RMDs or required minimum distributions yet, then your number would be 72.
Okay, very good. I have another question here, but I'm going to defer back to something that both Pamela and Opal said at the beginning, and that is that Pamela cannot answer personal questions that are specific to your situation. So I will refer you back to all of the links that Pamela has shared with you. If the question you have asked is really related to your personal financial situation, I apologize for that, but that's the way we have to do things.
Mhm.
If you are retired on a fixed income, but have savings and retirement accounts, should you go conservative or some risk in investments?
And on a fixed income, let me take
Retired
that back
fixed income.
to, are they past the 72, or they're taking RMDs yet?
Don't know.
Okay, if we can clarify that question, I'll come back.
Okay. And I'm switching over to chat room. And Pamela, I don't know whether you can answer this. It's
Okay.
come up twice in the questions. I'll ask it and then let you make a decision on that one. What are your thoughts on annuities? And if there is more than one type, is one better than another?
Mm-hmm. Yeah, that's an opinion question, but I'm gonna put out, if you are looking at annuities, in general, annuities are good income options for retirees because it basically guarantees an income stream through it. There are a variety of different ones, so you want to evaluate which one is better. There's fixed annuities, there's fixed income annuities, there's variable ones. So that's one that you do want to consult a personal financial advisor for your own particular situation to see which one is best for you. But an annuity provides a lifetime stream of income for you, so it may be a good fit for your overall retirement. But like I said, you do want to consult a professional to see where it fits in your overall retirement plan.
Okay. Should you include the value of your house in calculating retirement assets if you don't plan on moving?
Probably not, because you're not going to liquidate and it's not going to provide any resources or income resources for you. With that, the only time to do that is that if you were going to sell or get proceeds from the home, and then it would become retirement assets. Other than that, if you decide to stay in the home, then you would not include that in the calculation.
Okay. Is there such a thing as a ballpark figure for the typical cost of an advisor? What might someone expect to spend if they do look for a financial advisor, and or what is it based on?
Yeah, I'm going to refer you guys back to that AARP interview and advisor tool. So you want to take a look at that. Advisors range in terms of how they're compensated. Some do just a fixed fee or flat fee. Some do percentages. Some do commissions or on compensation. So that's kind of a broad question on that. So with the interview tool, you'll be able to go through what credentials financial advisors have, the typical range of what they would charge you, and then how they're going to get paid. So I always suggest interviewing, probably 2 or 3, go through that checklist that the interview tool has on AARP, and ask them those specific questions on how are they compensated, what's the general range that I can expect to pay for your services, and then interview about 2 or 3 people to go from there.
Okay. And along the same lines, do you need an advisor just to set up a retirement plan? Or does a financial advisor generally stay with you to manage your funds?
Mhm. Some do both. Some just kind of do planning and some do management. Again, that's kind of back to that compensation on what would you like the advisor to do for you if you want help doing, helping you set up the plan and also managing money, or just doing the retirement scenario planning to see if you're where you are do you have that gap similar to Pat and Ronnie on that. So that will also depend on kind of the level of services that you want from an advisor.
What things should someone take into consideration if they're deciding to pay off their home or not?
Mm-hmm. One of the things you want to consider, what kind of other tax deductions will you have? Because if you don't have a mortgage interest, that could affect your tax rate there. Do you have enough liquid assets available still to fund your retirement? So if you took a large chunk to pay off your mortgage, remember that amount is going to be out of your assets. That's going to count. So those are some of the factors, the kind of the tax implications, and also the liquidity of what you want to do if you're taking retirement resources to pay it off. Is that a good use of your money? Again, like I said, a financial professional will be able to walk you through those scenarios to see what's best in your best interest.
Okay. Could you explain again the catch-up contribution for employee 401k?
Mm-hmm. So if you're over age 50, they will allow you to put in an extra amount into your 401k. This is only if you're maximizing your 401k though. So if you're to the maximum, which I believe this year, 2022 is 20,500, that's your maximum. And then if you're over age 50, you're allowed to put in an extra $6,500 into your 401k program. So that's the catch up. It allows you just to put in a little bit extra because I guess now that you're getting older and they want you to put more money into your retirement plan. That's what the catch up provision is.
Okay. Suggestion of a ratio between deferred and non-deferred. Should it be 50-50? Is that too personal?
Yes. Yes. Yeah, that would depend on each individual
Okay.
I could answer it this way in terms of decide whether, what your tax structure looks like. If you're think of tax diversification when you want to consider the percentages, so to speak, of that. How much do you have in kind of pre-tax bucket? How much do you have in tax-free bucket? How much do you have in kind of only taxable on gains? There are kind of 4 different quadrants for tax diversification: pre-tax, tax later, tax-free but not taxable, and then there's tax on gains, and then there's kind of taxes that you don't pay federal tax on. So that percentage will depend on kind of your overall tax diversification in each of those different buckets. You want to be lopsided on tax deferred, then your tax bill is going to be a little higher in the future versus what you're doing now. So I would suggest taking a look at where all of the assets are placed right now, and then you can kind of see where the percentages lay, and then where do you want to be. And then again, working with a professional to determine your own personal situation on what percentage that should be.
Okay, I will clarify again, because a lot of the questions that I'm seeing really fall on the personal side of things. I do want to go back. The individual that asked a question about minimum required minimum distributions, there we go, has clarified that this individual is working past 70. Can I keep working, or am I going to be penalized with higher taxes?
No, I mean, you can continue to work past that age. You don't need to start taking until you actually have left of service. So your RMDs won't kick in until then. Um, I think that was the person on the fixed income, right? It was that.
Yes.
Okay. You have to determine how much or you are on your fixed income, and then how much percentage you're going to need to start taking out of your retirement plans on that. But you don't need to do anything until you've actually separated from your employer and your employer plan to take money out of it.
Okay. This is an interesting question. I don't think I've seen this one come up before.
Okay.
It's kind of personal, but kind of not. Um,
Okay.
I live 20 miles from another state. People actually move to the other state for better retirement benefits.
Okay.
What would those be, moving from state to state for different benefits?
Not knowing the states, but some things to consider would be, for example, if you're a federal employee, some states don't tax federal pensions. So that could be a benefit and in terms of your tax structure. Some may not charge, sales tax or, other benefits, Social Security benefits and things like that. So you want to look at the states that you're moving in. I know some of the states up in the New England area, they don't tax federal benefits because I have some people in that area. So those are some of the things that people probably, if they're 20 miles from another state, if it makes a huge difference on the taxability of certain benefits, may want to just hop over another 20 miles and go to the next state in order to save money on some of those things.
If you sell your home before you retire, is there a capital gains penalty once I do retire?
There is depending on, if it's a married couple or single, but you get a capital gains exclusion of 250,000. With a couple, it's double. So basically 500,000 of capital gains exclusion. And then they take that off the top. And then if there's money still left on the gains, then that's what you're taxed on. But you do get an exclusion for that.
Okay. This is going to be my last question for you, Pamela.
Okay.
Should we wait the additional years to retire at full retirement age when we could have been receiving benefits monthly all along?
Mm-hmm. Yeah, that's again another question probably for the Social Security calculator, because then you will be able to see how much kind of that break even for Social Security. Again, remember the 25% reduction that you get, anything before your full retirement age will be reduced. I know a lot of times people have the philosophy that I could be getting money all along. I don't know if Social Security is going to be there, whatever. So you want to run the calculator for yourself to see where that break even is for that. If you want to take it with the haircut basically, or wait another year or at full retirement age, you need to kind of see that. That is another personal calculation you want to take a look at in the Social Security calculation.
Very good. Lots of comments thanking you for your time and for the information that was shared here today. And for those of you that asked questions that were truly on a more personal basis, I would refer you back to the websites and the AARP sites that Pamela mentioned. You will get a follow-up email that will have all of those resources listed for you. And I'm going to turn the program back over to Opal Elliott for closing remarks and additional comments. Opal, are you there?
I am here. And Pam, I know that you wanted to make some closing remarks. Is that
Yeah, just to kind of recap before I turn it back over to you, Opal. Just remember to reevaluate your savings, review your plans once a year, at least once a year. If you do have a partner and or spouse, make sure both parties are privy to all of the household financial information. No hiding details from people as you're planning for the retirement, because it makes a difference. We definitely, again, hope that you've learned a lot in this session. So just to recap, we reviewed ways to determine how much money you would need in retirement compared to where you are now, and if you're on track. and then also the strategies to bridge the gap to discover if there is a gap in there. And don't feel discouraged or overwhelmed if you do. Just make sure you use some of the resources that we mentioned tonight as well. So back over to you, Opal, to wrap it up.
Okay, well, on behalf of AARP Virginia, I really would like to thank you for joining us this evening and express our gratitude to Pamela Sams for sharing her valuable time and expertise with us this evening. I really know from all the comments and questions that this was a very important seminar for you all, and I could tell by the number of questions that you found it very valuable. Sometimes I think about when I retired some 10 or 11 years ago, that I wished I had started before my early 60s, but maybe in my early 50s to attend these type of seminars. So now we'd like to get your feedback on our program. In the chat box, you'll see a link to a survey. Please click on the link and take a few moments to share your feedback with us. We'll also send this link in a follow-up email. So if you enjoyed the program and want to join us again, we will be offering it again in February. You can get the details for the program and all of our upcoming events by visiting our calendar of events at www.aarp.org/virtual VA. That's www.aarp.org/virtual VA. So until we meet again, we encourage you to continue thinking about and planning for your secure financial future. Have a great evening and thank you for coming. Bye-bye.